Arabia, the United Arab Emirates, and Bahrain and
have all cut diplomatic ties with Qatar.
In August 2017, Hurricane Harvey made landfall on the coast of Texas.
New allegations this week hit Home Capital's stock price hard. Ontario regulators claim the company misled its shareholders.
A massive cyber attack is spreading across the world, and it has impacted numerous businesses in Europe, including banks, energy companies, telecom operators, retailers, even government agencies.
The number of class action lawsuits against Equifax keeps going up.
We're here in Bahrain with Fred Bernanshawi, Managing Director of Deshret Capital. Fred, why is it so important for businesses to de-risk their operations?
There are three main benefits, Reem. One, the value of the business will be higher. Simply put, investors will pay more for operations that are less risky. In fact, for mid to large size businesses, de-risking operations is more powerful than increasing sales or boosting margins. Two, their performance will be stronger. So businesses with less risky operations can get better financing from lenders, they can offer more competitive terms to clients and suppliers, and they will limit the volatility in their cash flow. And three, it's about maximizing protection to investors. So they limit the downside risk to shareholders and creditors.
I understand that Deshret Capital de-risks operations by linking risk management to insurance to finance. Now, many businesses already buy some form of insurance, so isn't their risk lower?
It's a very good question, Reem. The simple answer is no, because of two things. One, most businesses are under the illusion of security or protection whenever they buy insurance directly sold to them by a broker of insurance or insurance company. That's because insurance is mathematically made so that it rarely pays out, if ever, on large and meaningful losses. This could be property insurance, liability, professional indemnity, directors, officers, trade credit, mergers, acquisitions, you name it. The point is that insurance has to be structured correctly to the operations of the business, and it has to be triggered correctly in the event of a loss. And this has to be done by a party that's independent completely from a broker, an insurance company, and who's not compensated by commission. And the funny thing is, the total cost of structured insurance is actually less than that of off-the-shelf insurance in most cases. And the second reason to answer your question is most businesses view insurance as a substitute to risk management. That's wrong. Risk management is your first line of defense that's supposed to reduce your initial risk quantums. But there will always be risk left. That's called residual risk. And that's when insurance comes into play, to protect the business against such residual risk.
But then, why are there still many businesses not implementing operational risk management and buying off-the-shelf insurance directly from a broker or insurance company?
That's another fantastic question, Reem. I think it's about two main things. One, raising awareness. Investors, boards, CFOs, and other executives are very busy in their day-to-day. And it's easy to be misinformed or misguided, especially when it comes to insurance, which is really not taught in schools. And so it's our job to raise awareness about the technical elements of risk and insurance, which have a substantial effect on making or breaking the business. The second thing is that it's about caring and making other people care, whether it's through exerting influence or tying compensation to risk management goals. Whatever the mechanism, that's the job of investors, boards, CFOs, and other executives. Simply put, the more they care, the more money they'll earn over the long term.
Fred, thank you for being here with us today and for your insights on risk and insurance.
Thank you, Reem. It was a pleasure being here.